Investment psychology, the wisdom of historical blunders. Today I want to discuss what may be the most important subject in all of investing, one that receives far too little attention in business schools and financial textbooks. I want to talk about investment psychology, and specifically, what we can learn from the great blunders of financial history. You see, the mathematics of investing is simple. Any intelligent sixth grader can understand compound interest and basic valuation, but the psychology of investing, that's where the real challenge lies. The greatest threats to your financial success are not out there in the economy or the markets. The greatest threats are right here, between our own two ears. Let me tell you a story about two neighboring towns, separated by a river. The towns were identical in every way. Same resources, same opportunities, same starting point. But they developed two very different approaches to wealth, and their stories hold powerful lessons for us today. The Tale of Two Towns. In the town of Steadfast, the people believed in gradual, sustainable progress. They built their homes on solid foundations, saved a portion of their harvest each year, and invested in improvements that would pay off over generations. They understood that real wealth was built slowly, through consistent effort and prudent decisions. Their approach to life was captured in their favorite saying, "The best time to plant an oak tree was 20 years ago. The second best time is today." Across the river in Boomtown, the people were always looking for the next big thing. They loved excitement, quick profits, and exciting stories. They would abandon proven methods for new schemes that promised spectacular returns. Their history was a series of booms and busts, moments of glorious prosperity followed by devastating crashes. Their motto was, "Strike while the iron is hot." Though they often struck when the iron was merely warm, or sometimes not even metal at all. Now, you might think Steadfast was boring. There were no dramatic success stories, no overnight millionaires. But over 50 years, the steady compounding of their sensible decisions made them genuinely prosperous. Their children inherited stability and opportunity. Their community had robust public services, well-maintained infrastructure, and a deep sense of security that permeated daily life. Boomtown, meanwhile, had produced many spectacular success stories, but also heartbreaking failures. The net result was that most people ended up worse off than their counterparts in Steadfast, despite all the excitement and activity. Their public services were erratic, their infrastructure was patchy, and an undercurrent of anxiety ran through the community as everyone wondered when the next boom would end. The difference wasn't intelligence or opportunity. The difference was psychology. The greater fool theory. One of Boomtown's favorite games was called Tulip Mania. It started simply enough. A merchant imported some beautiful tulip bulbs from abroad. People admired them, and demand grew. Soon, people weren't buying tulips to plant in their gardens. They were buying tulip bulbs to sell to someone else at a higher price. At the peak of the madness, a single tulip bulb was worth more than a fine house. People traded their land, their livestock, their life savings for paper certificates representing tulip bulbs that hadn't even bloomed yet. Everyone knew the prices were ridiculous, but everyone thought they could sell to a greater fool. The local tavern was filled with stories of ordinary people who had become wealthy overnight through tulip trading. These stories created a powerful social pressure to participate, lest one be left behind. Then one day, the music stopped. A wealthy merchant who had been buying huge quantities of bulbs suddenly decided to take his profits. He placed a large sell order and found no buyers at the current prices. He lowered his price slightly, then significantly. Still no buyers. Word spread through the town square. Panic set in. Within weeks, tulip bulbs were worth less than ordinary onions. Fortunes vanished overnight. Families who had traded their homes for paper certificates found themselves destitute. Now, you might think this is just a historical curiosity from 17th century Holland. But I've seen the same story play out again and again throughout my career in the dot-com bubble, the housing mania, the cryptocurrency craze. The technology changes, but the psychology remains identical. People still convince themselves that this time it's different, that traditional valuation metrics don't apply, that they'll be able to sell to someone more foolish before the music stops. The lesson is simple. Never buy an asset based on the belief that someone else will pay more for it tomorrow. That's not investing. That's greater fool theory. Always buy assets because you believe they're worth what you're paying based on their fundamental ability to generate cash or provide utility. If you cannot articulate why an asset is worth its price based on the cash it will generate for you over time, you are speculating, not investing. The herd instinct. Another pattern I've observed in Boomtown's history is what we might call herd behavior. When one person discovered gold in the hills, everyone rushed to stake a claim. When one farmer had success with a new crop, everyone planted the same crop the following season. When a particular style of architecture became fashionable, every new building had to follow that style. The results were predictable. The gold rush led to overcrowded mines and environmental damage. The crop frenzy led to oversupply and collapsing prices. The architectural trend led to houses that were poorly suited to the local climate. In the stock market, we see this same herd behavior constantly. When a sector gets hot, whether it's internet stocks in the 1990s or electric vehicle companies today, everyone piles in. Money flows in, prices get disconnected from reality, and eventually the bubble bursts. The early participants may do well, but the latecomers inevitably suffer losses. The wise investor learns to recognize this herd behavior and has the courage to stand apart from it. This doesn't mean being contrarian for its own sake. It means having the independence to think for yourself and the discipline to stick to your principles when the crowd is euphoric or panicked. When everyone is rushing into a particular investment, that's often the time to be cautious. When everyone is fleeing, that's often the time to be greedy. The dangers of overconfidence. Boomtown had its share of charismatic leaders who were absolutely certain about their predictions. One man famously declared, "This time it's different," right before his shipping company went bankrupt during a trade dispute. Another insisted, "We've abolished the business cycle," just before a devastating recession hit. A third proclaimed, "Real estate never goes down," months before the property market collapsed. Overconfidence is one of the most dangerous psychological traps in investing. The smarter you are, the more susceptible you may be, because you're skilled at constructing rational-sounding arguments for why your preferred outcome is inevitable. You can gather data, build models, and craft narratives that support your view while dismissing contradictory evidence. The truth is, the future is always uncertain. The economy is a complex, adaptive system that nobody can predict with consistent accuracy. The wise investor acknowledges this uncertainty and builds a margin of safety into every decision. They recognize that being right 6 times out of 10 can make you very successful, provided you manage your risks properly. I've found that the most successful investors are not those who make the most accurate predictions, but those who are best prepared for being wrong. They focus on understanding what they own rather than predicting what will happen next. They ask, "What could go wrong?" rather than, "How much could I make?" The anchoring trap. Here's another psychological pattern I've observed. In Boomtown, when a piece of property once sold for $100,000, people would forever after think of it as a $100,000 property, even when market conditions changed dramatically. If it later sold for $80,000 in a declining market, people would call it a bargain. If it sold for $120,000 in a rising market, they would call it overpriced. This is what psychologists call anchoring. We get fixated on a particular number or reference point, and it distorts our judgment. We give that anchor more weight than it deserves in our decision-making. In investing, we see this when people refuse to sell a stock that has fallen dramatically because they're anchored to the price they paid. "I'll sell when it gets back to $50, they say, even when the fundamentals have deteriorated permanently. We also see it when people won't buy a wonderful business because its price is at an all-time high, even though the business is worth far more today than it was in the past. The wise investor understands that the price you paid for an investment is irrelevant to its current value. What matters is what the business is worth today and what it's likely to be worth in the future. Your purchase price is history. It shouldn't influence your decisions about the present. Every day you should ask yourself, if I didn't already own this investment, would I buy it at today's price? If the answer is no, you should probably sell. Confirmation. Bias. The people of Boomtown were brilliant at finding information that supported their existing beliefs. If they believed a new mine would be successful, they would seek out every positive rumor and ignore any warning signs. They would gather in echo chambers where everyone reinforced the same optimistic view. This tendency, what psychologists call confirmation bias, is incredibly powerful. We naturally gravitate toward information that confirms what we already think and avoid information that challenges our views. We interpret ambiguous information in ways that support our existing positions. We remember facts that support our beliefs and forget those that contradict them. The wise investor actively fights this tendency. They seek out disconfirming evidence. They ask themselves, what could go wrong with this investment? They try to prove themselves wrong rather than right. They deliberately expose themselves to viewpoints that challenge their own. I've found that the most valuable exercise when considering an investment is to write down all the reasons it might not work out. If you can't think of at least 3 or 4 genuine risks, you probably haven't thought hard enough. Better yet, find a smart person who disagrees with you and listen carefully to their arguments. The narrative fallacy. Human beings love stories. We're wired for them. In Boomtown, the most successful promoters weren't those with the best numbers. They were those with the most compelling stories. A merchant could sell shares in a shipping venture to the New World more easily if he told thrilling tales of exotic lands and unimaginable riches than if he presented sober projections of potential returns. There's nothing wrong with stories in themselves. The problem comes when we prefer a good story to hard evidence. When we fall in love with the narrative of a company changing the world and ignore the reality that it's burning cash with no path to profitability. When we invest in a story stock because the vision is exciting, even though the business fundamentals are weak. The wise investor appreciates a good story but demands that it be backed by numbers. They want to see the actual cash flows, the realistic growth prospects, the durable competitive advantages. They understand that while stories can inspire, only numbers can validate. A wonderful story is not a wonderful investment if you pay too much for it. Loss aversion. Here's a fascinating pattern psychologists have identified. People feel the pain of loss about twice as powerfully as they feel the pleasure of equivalent gains. This loss aversion leads to all sorts of irrational behavior. In Boomtown, this manifested as people holding on to losing investments far too long, hoping to avoid crystallizing the loss. They would watch their investments decline by 50%, then 70%, then 90%, all because they couldn't bear to admit they were wrong and take the loss. This behavior was captured in their saying, "It's not a loss until you sell." The wise investor understands that losses are part of the game. What matters isn't whether every investment works out. That's impossible. What matters is that your winners significantly outweigh your losers over time. A loss that you take early and move on from is far less damaging than one that you hold on to indefinitely, hoping for a recovery that may never come. Taking a small loss early is often the wisest course. It frees up capital for better opportunities and prevents a small mistake from becoming a catastrophic one. The goal is not to avoid losses entirely, but to ensure that your gains are larger and more frequent than your losses. Recency bias. Another pattern I've observed is what we might call recency bias, the tendency to overweight recent experiences and underweight long-term history. In Boomtown, if the weather had been good for a few seasons, people would assume it would always be good. If a particular investment had done well recently, they would assume it would continue to do well. If property prices had been rising for several years, they would come to believe that property only goes up. We see this in the markets all the time. After a long bull market, people start to believe stocks only go up. After a crash, people become convinced they'll never recover. After a period of low volatility, people underestimate risk. After a period of high volatility, people overestimate it. The wise investor studies history and understands that markets move in cycles. They know that trees don't grow to the sky and that winter always follows summer. They prepare for different seasons rather than assuming the current weather will last forever. They understand that reversion to the mean is one of the most powerful forces in finance, the seduction of activity. In Boomtown, busyness was often confused with productivity. People who were constantly buying and selling, making deals, and chasing opportunities were admired for their energy and initiative. The town square was always bustling with activity, with people rushing from one deal to the next. But much of this activity was counterproductive. The transaction costs piled up. The constant switching between strategies prevented any one approach from bearing fruit. The frenzy of activity often led to poor decisions made in haste. As one wise observer noted, they were digging up their seeds to see if they were growing. The wise investor understands that in investing, as in farming, there are seasons for action and seasons for patience. Most of the time, the best action is no action at all. Once you've made a good investment at a sensible price, your job is mostly done. The compounding will happen on its own if you just leave it alone. I've often said that the stock market is a device for transferring wealth from the active to the patient. The evidence strongly supports this view. The more you trade, the more costs you incur, and the more likely you are to make mistakes. Successful investing is often about doing very little, very well. The wisdom of knowing what you don't know. Perhaps the most important psychological insight comes from the ancient Greek philosopher Socrates, who declared that the beginning of wisdom is the recognition of your own ignorance. In Boomtown, the biggest blow-ups consistently came from people who were absolutely certain about things that were inherently uncertain. The shipping magnate who was sure trade policies wouldn't change. The banker who was convinced housing prices never fall nationally. The tech entrepreneur who believed eyeballs were more important than earnings. The wise investor cultivates intellectual humility. They're quick to recognize what they don't understand and slow to make predictions about an uncertain future. They focus on businesses and industries they can comprehend rather than chasing whatever is popular at the moment. They're comfortable saying, "I don't know," when faced with questions about the future direction of interest rates, the economy, or the stock market. This concept of the circle of competence is fundamental. Know what you know, and equally important, know what you don't know. Operate within your circle of competence and be very cautious about stepping outside it. It's far better to be approximately right in an area you understand than to be precisely wrong in an area you don't. Learning from history now, you might wonder why we keep making the same mistakes generation after generation. Why don't we learn from history? Part of the answer is that each generation believes their situation is unique. This time, it's different, they declare, right before making the same error their grandparents made. They point to new technologies, new financial instruments, or new economic theories as evidence that the old rules no longer apply. Another part of the answer is that the specific circumstances change, which makes the underlying pattern harder to recognize. Tulip bulbs become internet stocks, become cryptocurrency. The surface changes, but the psychological dynamics remain the same. The players and the props change, but the script is remarkably consistent. A third reason is that during bubbles, the people who are cautious and skeptical often look foolish in the short term. While their neighbors are getting rich on paper, they're sitting on the sidelines. This creates tremendous social and psychological pressure to join the party, even when you know it's likely to end badly. The wise investor studies financial history not for the specific details, but for the recurring patterns of human behavior. They understand that while technology evolves, human nature remains remarkably consistent. They learn to recognize the signs of excess and the symptoms of mania. They develop the courage to stand apart from the crowd when necessary. Cultivating the right mindset. So how do we develop the psychological fortitude to avoid these historical blunders? How do we cultivate the temperament of steadfast rather than boomtown? First, develop self-awareness. Learn to recognize these psychological patterns in yourself. When you feel the urge to chase a hot stock, notice that feeling. When you find yourself refusing to sell a loser because you're anchored to your purchase price, acknowledge that tendency. When you're seeking out information that confirms what you already believe, catch yourself doing it. Self-awareness is the first step towards self-management. Second, create systems that protect you from yourself. Write down your investment criteria before you start looking at specific opportunities. Establish rules, like always insisting on a margin of safety that you refuse to break no matter how exciting an opportunity seems. Use checklists to ensure you're following your process. These systems serve as guardrails that keep you on track when your emotions are pulling you toward poor decisions. Third, study history. Read about the South Sea bubble, the 1929 crash, the Nifty 50, the dot-com bust, the 2008 financial crisis. Look for the common psychological patterns. See how people justified irrational behavior at the time. Notice how each generation thought they had discovered something new, only to learn the old lessons anew. History doesn't repeat itself, but it often rhymes. Fourth, find the right role models. Surround yourself with people who think independently and value substance over excitement. Read the letters of investors who have demonstrated psychological discipline over long periods. Learn from those who have successfully navigated multiple market cycles. Their wisdom can guide you when your own judgment is being tested. Fifth, practice patience. Learn to be comfortable with inaction. Understand that wonderful investment opportunities are rare, and when they appear, you need to have both the capital and the courage to act decisively. As the people of Steadfast understood, most of the work in growing an oak tree is waiting, the long game. Ultimately, successful investing is not about being the smartest person in the room. It's about having the right temperament. It's about being patient when others are impatient, fearful when others are greedy, and greedy when others are fearful. It's about recognizing that the market is a voting machine in the short term, but a weighing machine in the long term. The historical blunders we've discussed today all stem from psychological tendencies that are hardwired into human nature. We're social creatures who want to belong to the herd. We're pattern-seeking creatures who love compelling stories. We're emotional creatures who feel losses more powerfully than gains. We're overconfident creatures who believe we know more than we do. The wise investor doesn't try to eliminate these tendencies. That's probably impossible. Instead, they learn to recognize them and manage them. They build systems and habits that help them make rational decisions, even when their emotions are pulling them in the opposite direction. They understand that investing is as much about managing themselves as it is about managing their portfolio. The people of Steadfast weren't psychologically superior to the people of Boomtown. They just had better systems. They had traditions of saving, norms of prudent investment, and social reinforcement for long-term thinking. They celebrated patience and discipline rather than quick wins and flashy successes. You can create the same psychological environment for yourself. You can be the steady investor in a world of excitement chasers. You can be the voice of reason when others are losing their heads. You can build the habits and systems that will help you avoid the psychological pitfalls that have tripped up so many investors throughout history. Remember that the greatest investment you can make is in your own psychological development. Learn from history's blunders. Understand the patterns of human behavior that lead to poor decisions. Cultivate the temperament of the wise investor. If you can master the psychological side of investing, the mathematical side will take care of itself. You'll avoid catastrophic mistakes, you'll make better decisions, and you'll be able to stay the course through the inevitable market cycles. You'll become not just a wealthier investor, but a wiser one. That's the real wisdom we can glean from history's blunders. That's the path to becoming the kind of investor who builds lasting wealth rather than chasing temporary excitement. That's the journey from Boomtown to Steadfast.